So will the new year hold new troubles for stocks, or can the rally get back on track? And I guess the key here is, we mentioned the dollar and the yields. If they keep going higher, what kind of headwinds will they be?
Look, there's no question that significantly higher yields are bad for the equity market. But as we talk about quite often, I don't think anybody wants to see yields diving. And I think a 10-year below 3.5 also isn't a great sign here. The dynamic that we're going to talk about, budget deal, new government spending, no government spending, no limit to government spending, new administration. I mean, this is part of the dynamic that I think is what was driving yields over the last couple of days. I mean, typically, when we talk about the Fed and what part of the yield curve they can control, we typically talk about the short end, but not necessarily the long end. And that's more of a barometer of inflation. But it's also a barometer of other factors, including technical factors, but including budgetary factors that I think are at least in today's headlines, part of what I think we would be talking about. I think for now, this move is more of a function of how significant you've had a breakout now above some of the recent resistance. The dollar moved to, 108, almost 109, at least at some point today, and really through at least the top of the old range where you had a bit of a double top at 108, probably feels for people out there that are fearful that the dollar could go to 114. And in that case, you start to have this question about multinationals. By the way, a dollar that high is certainly going to at least damp down some of the inflation. I mean, it's at least an alternative to at least what's been going on with inflation. So today's action after the volatility of yesterday is a little concerning because, again, these would be factors that I think could lead to more volatility if you have these kinds of big moves. But I think we can't lose sight of the fact that going into yesterday's Fed meeting, you had the markets that had rallied almost 14% from Fed meeting to Fed meeting. I mean, I think we need to relax a little bit in terms of talking about the equities, but these two factors that we're leading the show with are things we have to be watching.
Yeah, and what is also interesting is that going in, looking ahead to next year, a lot of shops in the street were anticipating the dollar to peak sometime in the beginning of 2025 and then to decline. But here we are. I mean, if the Fed is taking out 50 basis points of cuts next year, then those estimates need to be revisited. And so then you think, is that hit plus the geopolitical uncertainty abroad, will that make the dollar even stronger?
Well, it's interesting. I mean, for the Trump administration, they do a lot of things that would be supportive of the dollar. And yet also he talks about not wanting a strong dollar. So I don't know where that's going to end up. I think
either does he, by the way.
It's what?
Either does he, by the way.
Well, none of us know, actually. Okay. Right. I don't know. I think about when multinationals, it's not great for them when they're importing those dollars where they sell abroad and get fewer EPS back. I don't know. I always sort of discount those as really just wanting to see how the business is rather than what the EPS is in the short term. So I think, to me, the things that weigh more heavily are tariffs, which obviously are tied in. But that, to me, has a bigger, if we are in a tariff war, that's more problematic to me, to the market, than the dollar, even though it relates to the dollar.
Yeah, and I would just say this. If you have that dollar that remains strong or gets stronger, and you have these multinationals that are they're generally selling into weaker economies. I mean, that's also something that I think is really important. And then there's another thing to look at. A lot of people thought, well, let's look at the Russell 2000. Let's look at small caps. They're not going to have the same pressures as they would from a strong dollar. But they also now, if rates are going to stay higher for longer, they have a higher interest expense. They have a higher access to capital. And I think those are all things that are probably restraining growth to some degree. And then to start, your question was like the dollar strength, the yields, and this or whatever. I think we got to focus on why this is all happening right now, right? So, everyone had predicted a recession that never came in 2023, and then we had this kind of spending boom in and around generative AI. If you look outside the Fateful Eight over the last year or so, what?
You're still trying to push
what? No, it's okay.
Go ahead. Have a ball, Dan.
But I think embedded in a lot of those consensus estimates for 15% year-over-year earnings growth next year is that other sectors are going to kind of pick up the baton a little bit. And I'm not just so sure in that environment where we're talking about higher for longer and we're talking about a stronger dollar. So, and then I go back to Goldman Sachs, who, remember in October they suggested that annual returns for the next 10 years are going to be about 3%. Yet their economist thinks that growth in the U.S. next year is going to be better than expected. I think about 2.5% GDP growth versus consensus at 2%. Now, I'm not putting those things at odds. I just think there's a lot of folks who think both of those sort of things, low returns, but better than expected growth. And I don't think both of those things can be true.